7. Ways to use debt to create wealth. The Insider's Guide. What if I told you the fear of debt is the single biggest thing holding you back from building real, generational wealth? Seriously. For most of our lives, we're taught that debt is a four-letter word. We're told to avoid it, fear it, and pay it off at all costs. It's the monster under the financial bed. But what if that's a lie? Or at least, a half-truth designed to keep the average person playing a small, safe game? The wealthy? They're playing a totally different game. They see debt not as a liability, but as their number one tool for building fortunes. They understand there are two kinds of debt, and while one will definitely ruin you, the other is the engine for almost everything they do. It's how they buy assets, scale businesses, and create massive cash flow, often without using a single dollar of their own money. In this video, I'm pulling back the curtain on the 7 strategies that turn what you owe into what you own. This isn't about credit card sprees or fancy cars. This is the Insider's Guide to using strategic debt to build a life of financial freedom. So if you're ready to unlearn the fear and start learning how the rich really get rich, you're in the right place. The Great Mindset Shift. Good debt versus bad debt. Before we get into the 7 strategies, we have to get this one thing right. Without this critical mindset shift, nothing else I'm about to share will work. You need to fundamentally understand the difference between good debt and bad debt. This concept was made famous by Robert Kiyosaki in his book, Rich Dad, Poor Dad, and it's the bright, shining line between people who use debt to get richer and those who let debt make them poorer. Let's start with bad debt. This is the stuff you already know and hate. It's money you borrow for things that either lose value or produce zero income. Think high-interest credit cards used for designer clothes, a loan for a new car that loses value the second you drive it off the lot, or financing a vacation. These things take money out of your pocket. Bad debt is a consumer's game. It feels good for a second, but it's a financial ball and chain that makes you poorer over time. Now, let's talk about the secret weapon of the wealthy. Good debt. Good debt is the exact opposite. It's money you borrow to buy an asset that either grows in value or, even better, puts money in your pocket through cash flow. Think of good debt like hiring an all-star employee. You take on their salary, the debt, because you know they're going to generate way more profit for your company than they cost. The wealthy use good debt to buy real estate that pays them rent every single month, to scale a business that churns out profit, or to invest in opportunities where the return is higher than the loan's interest rate. Good debt is an investor's game. It's a calculated, strategic move to use other people's money, OPM, to build your own net worth. The debt isn't the burden, it's the leverage. It's a tool. And that's the most important word to remember. Tool. Debt is a tool. Like a chainsaw, it can be incredibly useful or incredibly dangerous. It can build a house or tear one down. The only difference is the skill of the person using it. Today, you're going to learn how to be the skilled operator. Now that you get the difference between good and bad debt, let's look at exactly how the wealthy put this tool to work. The 7 strategies. Way number 1. The cornerstone of wealth. The mortgage. The first and most common way people use good debt is one you might already know, but you've probably been taught to think about it all wrong. The mortgage. Most people see a mortgage as this scary 30-year burden they have to suffer through just to own a home. The wealthy see it differently. They see it as financial leverage in its purest form. They aren't just buying a house, they're controlling a large, appreciating asset with a tiny fraction of their own money. Here's how that works. Imagine you want to buy a $500,000 house. If you had to save up the full $500,000, it could take you decades. By then, the house would be worth way more anyway. But with a mortgage, you might only need a down payment of 10% or 20%. Let's say you put down 20%, which is $100,000. You just used $100,000 of your money to control a $500,000 asset. Now, let's say the property market goes up by 5% in 1 year. Your house is now worth $525,000. That $25,000 gain isn't a return on $500,000, it's a return on your $100,000 down payment. That's a 25% return on your capital in a single year, and that doesn't even count the equity you built by paying down the loan. That's the power of leverage. Contrast this with renting, where your money is just gone forever. It's a 100% expense. When you pay a mortgage, part of that payment builds your ownership stake. And while tax laws change, it's become less of a benefit for many in the US, for instance. Some homeowners can still deduct the mortgage interest, which sweetens the deal even more. The key is to stop seeing the mortgage as just a bill. It's a strategic loan you use to acquire a massive, wealth-building asset. Way number 2. Investing in your greatest asset. You. The second strategy is one of the most debated, but also one of the most powerful. Using debt to invest in yourself through education and skills, often with student loans. I know what you're thinking. Student loan debt is a national crisis that cripples millions. And for many, it absolutely is bad debt, especially when it's for a degree with low income potential. But that's not the whole story. The real question isn't, are student loans bad? It's, are you using them strategically? Good debt is an investment that provides a return. So, if you take on $50,000 in debt for a degree that boosts your lifetime earning potential by $500,000, is that a bad deal? Of course not. That's a 10x return on your investment. You're using debt to upgrade the most powerful asset you'll ever have, your own ability to generate income. The wealthy get this. They don't just ask about the cost of education, they ask about the return on investment. And the strategy doesn't stop there. Let's say your student loans have a low, fixed interest rate of 4%. Does it make sense to aggressively pay them off? Or would you be better off making the minimum payments and investing the extra money in the stock market, where historical averages have often been closer to 10%? You'd be profiting from the difference. Even better, what about your company's 401k match? It's a 100% return on your money. It's free. If you're so focused on paying down a low-interest loan that you miss out on free money from your employer, you are leaving a huge pile of wealth on the table. The insider play is to see education debt as venture capital for your career. Be smart about what you study, understand the potential return, and then manage the debt intelligently to maximize your overall net worth. Way number 3, scaling your business with other people's money. The third way the wealthy use debt is the engine behind almost every great business empire, using business loans to scale and grow. There's this romantic story of the entrepreneur who bootstraps a company from their garage with only their own savings. That's an amazing story, but it's almost always the slowest path. The wealthy know that to jump on opportunities and crush the competition, you need fuel. And the fastest way to get that fuel is to borrow it. They don't see a business loan as a sign of failure. They see it as an accelerator pedal. Why wait 5 years saving up profits to open a second location when you can get a loan? Open it now and start collecting 5 years' worth of extra revenue. It's all about using other people's money, OPM, to generate a return that's higher than the cost of borrowing it. For example, a food truck owner knows they could double their revenue by adding a second truck that costs $80,000. They could spend years saving that up, or they could get an equipment loan at 8% interest. If that second truck brings in an extra $100,000 in revenue a year, taking on that debt was a genius move. Business debt allows you to preserve your own cash for emergencies while using the bank's money to fuel your growth. It's the difference between staying in first gear and shifting into fifth. Relying only on your own cash is safe, but you'll never hit top speed. Way number 4, amplifying your gains in the market. This next strategy is where we get into more advanced territory. And it's something most financial advisors would never tell the average person to do. It's called borrowing to invest, or using margin. A margin loan is a loan from your brokerage that lets you buy more stocks than you could with just your own cash. The assets in your portfolio act as the collateral. So, if you have $100,000 in your account, your broker might let you borrow another $100,000, giving you $200,000 of investment power. Why on earth would you do this? Simple. Leverage. If your now $200,000 portfolio goes up by 10%, you've made $20,000. That profit is on your original $100,000 investment, a 20% return. You effectively doubled your gains. Now, I have to be very serious for a moment. This is a high-risk strategy. Just as leverage magnifies your gains, it magnifies your losses. If that same $200,000 portfolio drops by 50%, it's worth only $100,000. You still owe the brokerage the $100,000 you borrowed, which means your entire initial investment is gone. This is a margin call, and it's how people get wiped out. So why do the rich use it? Because they do it strategically and with caution. They might use it to buy during a market crash when they believe prices will recover, or to get cash without having to sell long-term investments and trigger a huge tax bill. On top of that, depending on your country's tax laws, the interest on a margin loan can sometimes be tax-deductible if you use it for investing, which can further tilt the math in your favor. Margin is not for beginners. It's a powerful tool for experienced investors who respect the risk, but it can be a massive wealth accelerator when used correctly. Hey, just jumping in for a second. We're getting into some pretty advanced stuff here, and if you're finding this eye-opening but also feel a little overwhelmed, I get it. To help you out, I've created a free, simple PDF guide called The Good Debt Blueprint. It breaks down all 7 of these strategies with clear examples to help you figure out which ones might be right for you. The link is right down there in the description. It's totally free. Now, let's get to one of my favorite strategies. Way number 5. The Alchemist's Secret. The principle of debt recycling. This 5th strategy is a brilliant piece of financial engineering. But a quick heads up, its power depends entirely on your country's tax laws. It's a popular strategy in places like Australia, but it's much trickier in others, like the US. Still, the principle behind it is something every investor needs to understand. It's called debt recycling, and it's like financial alchemy. It's the process of transforming bad, non-deductible debt into good, tax-deductible debt. Here's the idea. The loan on your personal home is usually bad debt from a tax perspective because the interest offers little to no tax benefit in many cases. An investment loan, however, is good debt because the interest is often tax-deductible against the income that investment generates. The strategy, where tax laws allow, involves paying down your non-deductible home loan while simultaneously borrowing that paid-off equity back out to use for income-producing investments, like stocks or a rental property. You essentially recycle the debt. Over time, you could theoretically convert a non-deductible mortgage into a fully deductible investment loan that is actively building your wealth. Again, this specific tactic is highly dependent on local tax rules and isn't a straightforward strategy in the United States, for instance. But the mindset behind it is universal. Always look for ways to make your debt work for you, not against you, especially when it comes to taxes. Way number 6, the cash flow multiplier. Strategic debt consolidation. The 6th strategy might sound like something for people in financial trouble, but the wealthy use it as an offensive weapon. We're talking about debt consolidation. Here's the difference in mindset. The average person consolidates high-interest credit cards into a lower-interest personal loan just to lower their monthly payment and get some breathing room. And then, what do they do with that extra cash flow? They spend it. The wealthy person sees an opportunity. They see that freed-up cash flow as fresh capital to be invested. Let's run the numbers. Imagine you have $30,000 in credit card debt at a painful 22% average interest rate. You consolidate it into a single loan at 9%. Suddenly, your monthly payment drops, freeing up an extra $400 a month. The average person says, "Awesome, an extra $400 for dinners out." The strategic investor says, "Awesome, an extra $400 a month I can automatically invest into an S&AMP, a 500 index fund." This move does two things. First, it saves you a fortune in interest payments. But more importantly, it turns a stream of money that was getting vaporized by high interest into a stream of money that's now building your wealth through compound growth. It's about plugging the holes in your financial bucket, bad debt, so you can finally start filling it up with investments. Way number 7, the Wealth Accelerator, strategic use of lump sums. This final strategy is about the decision you make when you get a chunk of cash, like a bonus, an inheritance, or a big commission check. Conventional wisdom screams, use it to pay off your debt. And look, if it's 22% credit card debt, yes, absolutely do that. But what if your only debt is a mortgage at a low 3.5% interest rate? The average person would take a $50,000 bonus and throw it all at the mortgage, because getting rid of debt feels good. The wealthy person stops and does the math. They ask one simple question: where can this money work hardest for me? They see two options. Option A, pay down a debt that's costing them 3.5% a year. The return on that move is a guaranteed 3.5%. Option B, invest that $50,000 in an asset they believe will return more than 3.5%, like the stock market, where historical average returns have been around 8 to 10%. By choosing option B, they're profiting from the gap. Their money is out there earning 10%, while their debt is only costing them 3.5%. They're generating a positive spread. Paying off the low-interest loan would be like choosing a 3.5% return over a potential 10% return. It's a decision driven by emotion, not math. This requires a huge mindset shift. It's about seeing your capital as an army of soldiers that you must send to the most profitable battlefield. Sometimes, the smartest move is to let cheap debt live on, while your capital goes out and captures much higher returns somewhere else. That is thinking like an investor. So, there you have it. 7 powerful strategies for using debt not as a chain, but as a key. We've covered everything from leveraging a mortgage to scaling a business to more advanced plays like margin loans. But the one thing that connects all of them is that fundamental shift in your thinking. The world teaches us to see all debt as a sign of scarcity. The wealthy see good debt as a tool of abundance. They know there's a universe of difference between borrowing to consume and borrowing to invest. One path leads to a life of financial struggle. The other can lead to financial freedom. Debt is a powerful force. It will amplify your financial decisions, for better or for worse. If you make bad decisions and buy liabilities, debt will accelerate your path to ruin. But if you make smart strategic decisions to acquire assets, it will accelerate your path to wealth faster than almost any other tool you have. You have the playbook now. The biggest change doesn't happen in your bank account. It happens between your ears. Stop fearing all debt and start respecting good debt as the powerful tool it is. If you're ready to really apply these ideas, don't forget to grab that free Good Debt Blueprint I mentioned. The link is in the description, and it's a perfect guide to keep on hand. Now, I have a question for you. Which of these 7 strategies was the biggest aha moment for you? Which one are you most curious to learn more about? Drop your answer in the comments below. I really do read every single one. And finally, if this video challenged your thinking, do me a huge favor and hit that subscribe button and turn on notifications. We go deep on real wealth strategies like this every single week. Thanks for watching. Now go turn what you owe into what you own.